I want a cap on credit card interest rates. No way. We're putting a 1-year cap at 10%, and that's it. They know it. They've really abused the public. The credit card companies have totally abused it. I'm not going to let it happen.
90% of credit card holders could see reduced access to credit as a result. People lose access to credit. Well, then what do they turn to? Are they looking at a payday loan with a 400 or 500% APR? Does buy now, pay later become even more commonplace? Credit cards are a valuable tool for millions of people. Mortgage rates are going to be interesting this year. We have not been below 6% on average for the 30-year fixed since the summer of 2022. I believe we will soon fall below that threshold. We could fall as low as about 5.5%. That gets some people off the sidelines.
Are credit card rates about to be capped this year? What is the future of consumer debt? We're going to find out with our next guest, Ted Rossman, Senior Industry Analyst at Bankrate. This video is sponsored by Kalshi. It's a fully regulated platform that lets you trade on real-world events from economic data to political outcomes. Sign up and use my code LIN, L-I-N. Link in the description down below or scan the QR code here. And new users will get $10 when you deposit $100. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. More on that later. Ted, welcome back to the show. Good to see you. Happy New Year.
Good to be here. Thank you.
Last time you were on the show in July of last year, auto loan delinquencies have already exceeded the recession levels in the subprime segment. We're going to follow up on that. I believe it's now at a 15-year high, according to Bankrate's research. First, let's talk about Trump's credit card rate plan that he announced late last week. This is what he has called for on Friday. The president declared that American credit card companies will be subject to a 10% cap on the interest rate they can charge customers. This move sent shares of large banks, including Citigroup, JP Morgan Chase, and so on, down between 1% to 4% in early trading on Monday. First of all, before we talk about what this may mean for the consumer, why do you think the Trump administration is doing this right now? Is it just because midterms are coming up later this year?
Yeah, it's a bit of midterm election year posturing. Affordability is Americans' key concern right now. And we've seen the White House throwing out all these different policies recently to try to address that. It's well-intentioned. Some of it, I believe, could backfire and have unintended consequences. But we could point not only to the 10% credit card rate cap proposal, but also things like the 50-year mortgage idea that was floated recently. That was really all about driving down monthly payments. The consequence is more interest overall, more time in debt. There was also that proposal to ban institutional investors from buying single-family homes. There are a lot of different aspects of this. There's the no tax on tips, no tax on overtime, no tax on Social Security. A lot of this comes back to that central theme of affordability or lack thereof, because that's the biggest thing straining consumers right now. The cumulative toll of several years of higher prices, people are worried about it.
Let's talk about how this may impact banks. First of all, do you think this is even going to be possible?
I don't believe this will end up actually happening. Some of that is a legal argument in that my understanding is that it would take an act of Congress to actually pass this sort of thing. Some say the president may be trying to apply voluntary pressure on the banks. There's no way they're going to lower rates to 10% on their own. Even something like a 36% cap, which is what the Military Lending Act caps for service members, even that would be a bit of an uphill battle for the banking industry to commit to. But right now, there is no federal interest rate cap for credit cards. 10% feels like a non-starter, but yet we're talking about it because the president's talking about it. Democrats like Elizabeth Warren and Bernie Sanders are talking about it. There have also been some Republican voices like Senator Roger Marshall climbing on board. So there is sort of this interesting group of bipartisan politicians who are coming around to this idea. It is an important issue because millions of Americans are dealing with high-cost credit card debt. And it is this real populist kind of slogan of, yeah, let's stick it to the big banks and lower credit card rates. The thing that I fear, though, is the unintended consequences, namely that banks say they would pull back dramatically on lending if they were capped at 10% credit card rates. The Electronic Payments Coalition says that 90% of credit card holders could see reduced access to credit as a result. That's why this bears watching.
Well, this is from Kalshi, a prediction market. Traders are predicting a 31% chance as of today that credit cards will be capped in some way this year. Okay, so to your point, banks may reduce their access to credit. I would have thought it was the other way. If I were a bank, let's say, and my interest rate is all of a sudden capped, wouldn't I want to at least open up new credit products to consumers to make back the lost revenues from credit card interest expenses?
Credit card lending is really all about risk assessment. An important notation here is that this is unsecured debt, of course. Some people don't pay it back. That's the worry for these credit card lenders. It's not like an auto loan or a mortgage where there's an underlying asset that you can seize. I know credit card companies have some avenues to pursue repayment. They can ding your credit. They can maybe take you to court and win some kind of judgment or wage garnishment. But in general, credit card debt is the easiest to discharge in a bankruptcy. It's not like an auto loan where you miss a couple payments and they repossess the car. This is one of the reasons why banks say they have to charge higher credit card rates. And these two opposing viewpoints are just so far apart right now that the average credit card rate's about 20%, but many people with lower credit scores are paying 25, 30, even up to about 36%, which again is kind of the unofficial ceiling because of that Military Lending Act. That's been sort of unofficially extended to others. The average store credit card charges about 30%. So 10 would just be a dramatic pullback. I know on the face of it would save people money and interest, but a lot of banks are saying it just would not be profitable for them. You have to account for the non-payment risk, the fact that they have other overhead when it comes to things like fraud protection, credit card processing, customer service. They say it just wouldn't be worth their while if they were capped at no more than 10% APR.
Yeah. Okay, well, this is kind of a nonpartisan issue, given that we have people from both sides of the aisle advocating for a cap on credit card rates. This is Bernie Sanders last week calling for a cap on the interest rate. So take a listen to his rationale, and we'll react together.
Credit card companies are abusing Americans.
So when Bank of America suddenly jacked her credit card's interest rate from 7.9% to 28%, this nurse was shocked.
Have the rules changed? Did I miss something here?
This really is disgusting.
Kevin and Nora Gardner Sinclair racked up nearly $20,000 in credit card debt in about 4 months.
Our roof started leaking. Our car broke down.
They pay $400 a month in interest alone.
What is going on, in my view, is extortion. It is loan sharking with people in three-piece suits.
Credit card balances are the highest we have seen ever, and delinquency rates are going up.
Sandy Knight of Dallas just received a letter from Citibank increasing the interest rate on her card to 29.99%.
6%, 8%, to 29%, to 30%. And that is outrageous. It is unfair.
It's a crime. It's crazy.
That's just his point of view, but let me get your reaction to this so far.
Well, I don't want anybody to be in credit card debt. Half of cardholders pay in full every month, and for them, life is great. They get rewards and buyer protections, and they avoid interest. For the other half, it's a significant issue. You have half of cardholders paying an average rate of 20%. About 2/3 of them have been in debt for at least a year. It becomes very persistent. Credit cards are a necessary financing tool, though. We see the most common causes of credit card debt are emergency expenses like medical bills and car repairs. And then second place would be day-to-day living, just groceries, gas, other essentials outpacing your paycheck. So the unintended consequence I worry about is if this cap comes to be and people lose access to credit, well, then what do they turn to? Are they looking at a payday loan with a 400 or 500% APR? Are they just going without certain purchases? Some say that this could actually dramatically slow the economy because people would have less money to spend and the consumer-driven economy could tip into recession. I know there are a lot of passionate voices warning against the dangers of credit card debt, and I don't want people to truly be carrying debt, but sometimes life gets in the way and you do need to bridge the gap for a bit. Credit cards are a pretty amazing tool when you think about this unsecured loan that you sign up once and you get this limit, and then you can basically use it whenever, wherever. it's actually a very generous product in terms of the flexibility. It can come at a hefty cost, although there are ways to reduce it, like paying in full or getting a 0% balance transfer card. I just feel like credit cards fill a necessary role in the ecosystem. And if not that, then what? Is it payday loans? Does buy now, pay later become even more commonplace? Although that's a little bit different, the way they underwrite that more one-to-one. Credit cards are a valuable tool for millions of people. So I do wonder what the replacement would be.
Okay. And then I guess ultimately on the credit card issue, and then we'll move on to other sectors of the economy, is a cap on the credit card rate, whether it be 10% or 20%, is a cap in the benefit of the American consumer, given that you said earlier, if there were to be a cap, banks may limit credit products.
10% is too low. That would lead to dramatic cutbacks in access to credit and rewards programs. Maybe people don't boohoo too much about rewards because they think that's more for rich people. There's actually a lot of lower and middle income people who benefit from cash back and airline miles. But even if we leave rewards aside for a second, that stat that 90% of Americans could lose access to credit if a 10% cap were enacted, that just shows the 10% number is too low. Now, federally chartered credit unions have an 18% cap. That would still be too low for banks' liking. They might agree to something like a 36% cap. I know some people think that might be like lipstick on a pig. I mean, that's not going to make a huge difference to the typical person. But, to me, rather than government intervention, the right answer here is pay in full if you can, or if you can't, pursue one of these legitimate strategies like a 0% balance transfer card or nonprofit credit counseling. The balance transfer business case is they try to bring you in with zero and then they jack the rate up after a year or two. You could dare to be different, though. Be among those who pay in full. I suppose if everybody paid in full, then credit cards would basically be debit cards and they wouldn't exist as we know it. You can work the system to your advantage, though, if you're among those who pay in full and get the rewards and the other benefits. I just think a 10% cap would backfire.
How do you, just sidestepping a bit now, I want to get your forecast for credit card and other rates for the rest of the year. How does one keep their credit score up, generally speaking? I mean, paying back debt is an obvious one, but there's ways to kind of game the system, right?
That's right. Generally speaking, you want to pay your bills on time, of course. You want to keep your debts relatively low. You want to show that you can successfully manage various types of credit over the long haul. So that would include revolving accounts like credit cards, also installment accounts like auto loans, mortgages. Coincidentally, credit cards are actually a great credit building tool, potentially, if you use them responsibly. Because unlike these other things, you're not going to get a mortgage just to build credit. You're not going to be approved in the first place. But also that's a huge, many years, big ticket item. You could get a credit card as a college student or a teenager or a young adult, and you get a no annual fee card. You pay it off right away. It's not just for payments and purchasing power. It can also be a credit building tool and a stepping stone where maybe you piggyback off a parent's credit card account as an authorized user, or you get your own student card or secured card or some kind of starter credit card. Using that responsibly can actually give you a leg up in the future when it's time to buy a car or a home or something else that you're going to need credit. Credit cards are often the entry point to building a credit history.
So when should a young adult or even a child start building a credit history?
I would say somewhere in the mid to late teenage years. Some banks will let you get as an authorized user on a parent's card even earlier than that. I'm not sure there's a ton of practical benefits for an elementary schooler or a newborn to be on there. But I would say around the age 16 or 17 is often a good time to start using credit cards. You can get on a parent's card as an authorized user. Their good credit history, hopefully it's good, can translate to you. I say 16 or 17 because that's generally when you're still living at home, but you're a bit more independent. Maybe you're driving, you're going out with friends, you can pay for the occasional dinner or tank of gas or movie. You're still under your parents' roof, so there is the opportunity for the teachable moments. It's not like you're off at college just doing your own thing. But both in terms of the practicality of building a credit score, earlier is better, but also just learning how to transact with plastic and mobile apps. It's different from bills and coins. And it's not just the way of the future, it's increasingly the way of the present. I do think it's important to teach our kids about how to use credit responsibly. So I would say somewhere in that 16, 17, 18 range is often a good time to get started. You will need parents' help at that age, though. You can't typically get a credit card in your own name until you're 21. Sometimes there's exceptions starting at 18, but I would say mid to late teens is a good time to get started.
So when your credit card company calls you up and says, hey, Ted, do you want to raise your credit card limit? Even if you know you're not going to use it, should you accept? Would it improve your credit score?
It does generally improve your credit score to have more available credit and be using less of it. So we're talking about your credit utilization ratio, credit you're using divided by credit available to you. In general, it is better to have more. Just make sure you don't use that as a trap to overspend and get into debt and pay interest, especially if it's a soft inquiry, meaning it won't hurt your credit score to apply for that credit limit increase. It really can only help you in the credit scoring system. Just, again, make sure you're not overspending and going into debt. This is also a reason why it helps to leave old accounts open. So instead of canceling an old credit card, you can either just leave it open in the background, maybe use it once in a while to keep it from going dormant and being canceled. Or you can do a product change. You have a card that you don't like anymore. Maybe the annual fee is too high or the rewards just don't suit you anymore. Do a product change. Shift over to something else from the same company. The benefit is that it keeps the available credit. That's what you want. More available credit and using less of it. People often say try to use under 30%. That's kind of a approximation. It's not like 29 is amazing and 31 is terrible. It's more of a sliding scale. If you're using 10% of your available credit, that's better than 30, which is better than 50, which is better than 70. It's better to keep that usage relatively low. One other thought on this is it's usually reported on the statement date. So make an extra payment in the middle of the month or ask for a higher credit limit. Knock that down before the statement even comes out, because it doesn't distinguish between what's paid in full and what's not. It's just whatever shows at a moment in time. So it's better to keep that low.
And what is that minimum payment that you have to make at the end of the month? I mean, there's some misconception from some people still that you only have to make the minimum payment. Can you just comment on that?
The minimum payment is really low. The typical formula across the industry is 1% of the balance plus interest every month. And that's what keeps people in debt forever and ever. And that's why we're talking about this credit card rate cap, because credit card debt is a nasty, persistent problem. If you have the average debt load, according to TransUnion, it's about $6,500. If you make minimum payments at 20%, which is roughly the national average rate, you're in debt for 18 years. You end up paying more than $9,000 in interest. The math is just brutal. This is where minimum payments are not enough. Just paying $35 or $50 a month, it's just not enough. You really need to pay a lot more than the minimum. No shame. A lot of people have credit card debt for practical reasons, but this is one to attack. These rates are so much higher than other financial products. You really want to make credit card debt payoff a priority. Get the balance transfer card, work with the nonprofit credit counselor, take on a side hustle, sell stuff you don't need, cut your expenses. It doesn't have to be forever, but if you buckle down for 6 months or a year, you make big progress, it's really a good thing for your overall financial life.
Okay, this leads me to this recent Bankrate report, 2026 credit card debt report. A quote from yourself: for millions of American households, credit card debt represents their highest cost debt by a wide margin. And the report cites or says that 61% of cardholders with credit card balances have been in debt for at least a year. That's up from 53% in late 2024. This includes 31% of those who have been in debt for at least 3 years and 21% who have been in debt for at least 5 years. Can you attribute this change to any fundamental shifts in consumer behavior or the economy? And that could explain why more Americans are entrenched in credit card debt than before.
A lot of it comes back to inflation. The fact that prices have risen an average of 25% over the past 5 years, that has outpaced a lot of people's wage growth. The Fed rate hikes that came in an effort to fight inflation are also a part of this, although credit card rates really just went from high to higher. They were in the 16s before these rate hikes. They went as high as 20.79 a couple summers ago, talking about the national average here. And now it's dipped to 19.7. But still very high. But really the biggest thing is just inflation cutting into purchasing power, making it more expensive to buy things. Again, it's generally practical stuff. It's medical bills, it's home repairs, it's car repairs, it's groceries. It's not usually a vacation or a shopping spree, but in a way that actually makes it even harder to attack this, because it's not like you can say, oh, well, if you just skip that one trip, then you're back in the good. It's an easy trap or hole to fall into, and it's hard to climb out sometimes. But that's where I would underscore the importance of these balance transfer cards, the ability to avoid interest for 2 years with the US Bank Shield Visa or close to it with other cards, or getting that nonprofit credit counselor to knock your rate down to 7% over the next 5 years, and really just being systematic about paying it down. Credit card rates are so much higher than other financial products. We're often talking 3, 4, 5x what people are paying for student loans, car loans, mortgages. It does track back to credit cards being unsecured loans, but it's a very expensive way to borrow.
So what is Bankrate's forecast for rates? So this is from Couch again. Will rates hit zero? This is talking about the Fed funds rate. You did write in a recent report that even a 25 basis point cut isn't going to dramatically affect consumer rates. Tell us more.
My expectation is that the Fed will cut 3 times this year, 3 quarter-point cuts in 2026, which would match what they did in 25. We have to remember that in 2022 and 23, the Fed pushed rates higher by 5.25 points in an effort to fight inflation. And then they only lowered by 1 point in 24. They lowered by 0.75 point in 25. So rates are still noticeably higher than they were for most of the 2010s and early 2020s. 3 rate cuts this year will not make a big difference to credit card borrowers, because if the rate goes from 19.7 to 19.0 or something like that, you hardly notice. That's just not enough to make a big difference. It could make a difference, though, for other products like mortgages. The Fed does not directly influence mortgage rates. They tend to track 10-year treasuries, but the Fed's an important input. So are things like inflation, economic growth, jobs, things like that. Right now, the average 30-year fixed mortgage rate is around 6.25%. Falling below 6 is a psychological breakthrough and actually a tangible financial breakthrough for someone trying to enter the market, trying to get a more affordable monthly payment. Mortgage rates are going to be interesting this year. We have not been below 6% on average for the 30-year fixed since the summer of 2022. I believe we will soon fall below that threshold. We could fall as low as about 5.5%. So not the ultra lows we saw during the pandemic, not the 3s or 4s, but 5.5, 5.75, that gets some people off the sidelines.
Sidelines in terms of buying, you mean?
In terms of buying, even refinancing, if you bought in the last couple of years, because a year ago, the average mortgage rate was around 7% for the 30-year fixed. A couple of years ago, it briefly hit 8% for the first time in decades. So there could be some refinancing for recent buyers, not those who locked into the pandemic lows of the 3s or 4s. But also, the more time passes, people are moving for other reasons too. I know there's the supposed golden handcuffs of, I locked in the 3% rate in 2020 or 21, and I'm just never going to leave. But life happens, right? You get married, you get divorced, you have kids, you move for a job, you move for family reasons. We're starting to see a little more inventory freeing up. I do think mortgage rates going into the 5s, especially the mid 5s, could get some buying activity spurred.
Going back to what we were talking about earlier about people leaving credit card balances for an extended period of time, this is a tweet that echoes many people's sentiments and actually addresses one of my own concerns: is how much debt should we permanently leave on your credit card statement? I'm not talking about thousands of dollars every month, but should we actually pay off the entire balance in full at the end of the month? This tweet writes, my credit score dropped when I paid off my car and student loans. Credit agencies said I should get more loans to increase my credit score. The system punishes you for not owing them money. They want you to be in debt. Credit scoring is a scam. Can you respond to that?
Well, you have some anti-debt crusaders like Dave Ramsey saying that credit scores are basically a bunch of baloney and it's basically a debt score and you shouldn't have debt. People sometimes need debt to buy a car, buy a home. Sure, ideally, we would rather pay cash for everything, but that's not always feasible. Credit cards are interesting because the way it affects your credit score is your credit card balance usually reports on your statement date. So it's certainly a best practice to pay in full before interest hits. But from a credit scoring standpoint, they're much more likely to look at what showed on your statement. So in other words, you might charge $4,000 in the month. If you pay it off before interest hits, well, that's good for that part of things. But if you have a $5,000 limit, you might actually, in my example, be using 80% of your available credit. That actually looks bad to the credit scoring system, even if you pay in full. So that brings us back to the idea of maybe making a mid-month payment or two, knocking that balance down before the statement even comes out. That's really optimal for your credit score. If you really geek out over this, sometimes people talk about the all zero except one method. So again, we want to make sure we're paying credit cards in full before interest hits, if at all possible. But some people even take it to the nth degree and they say, well, have all of your credit card statements show a zero balance and then just have one show a small balance. That may technically be the best way to truly optimize your score. It's probably overkill for most people. I would say the general rules of the road are pay in full before interest hits, because you don't want to be paying those 20+% credit card rates. But if you want to take it a step further, just make sure that your utilization is not too high. So, even if you're paying in full, you don't want that statement balance to balloon too much out of control. I've tried to get in the habit of paying my credit cards every other week. Like if you get paid every other Friday, make a credit card payment.
But do you pay
that can be good for your credit score and keep you on target?
Do you pay the entire balance, or do you purposely leave, let's say, a couple $100, Ted, just for the credit score system?
What may technically be best for your credit score is to show a small statement balance, not one that you're paying interest on.
Right.
But you know how if you pay in full, you typically get a
That's
3-week or so grace period. That may be optimal from a credit scoring standpoint. It's just show a small balance that you pay off before interest hits. We're kind of splitting hairs, though, between zero or small amounts. What you really want to avoid are big balances, especially if you carry them and incur interest. But even if you pay a big balance in full, even that presence on your credit report could be seen as a negative. It works a little differently for things like installment loans. Utilization is not as much of a factor there. But back to that tweet, paying off a car loan is a good thing and should be celebrated and is a good thing for your overall finances. I have heard of sometimes people having small negative impacts to credit scores after paying off loans, mainly because, maybe it shows a little bit less activity, but it's a good thing for your overall finances. Remember, too, that once you hit the mid 700s, you're good. So this FICO scale goes from 300 to 850, but lenders really stop distinguishing once you hit the mid 700s. Like an 800 is really good, a 780 is really good, an 820 is really good. You don't need to be perfect. So a lot of the splitting of hairs here is probably not super practical from a lending standpoint. You hit 750 or better, you're going to get the best terms.
Finally, let's talk about student loans. So some new regulations are set to take place this year, Ted, assuming no changes are to be made before now in July 1st, when these new changes are to be taking place. All new federal student loans will be placed under a new system called the Repayment Assistance Program. Again, effective, I believe, July 1st, which is income-driven and designed to simplify repayment and reduce the risk of overwhelming debt. According to this article, under the new law, graduate students will face a new borrowing limit with a proposed cap of $20,500 per year and a total of $100,000 for their degree. How is this going to change borrowing? We know that delinquencies for student loans have already been going up.
Yes, about 1 in 4 student loan borrowers are either in default or close to it. This has been a big problem. As we know, there was the long payment pause during the pandemic, and then there was the lag and the on-ramp, and now it's really come home to roost. It's been sort of a slow motion car crash just because of all the delays, but now we really see this showing up. And in 2025, the federal government started garnishing wages for the first time in 5 years for unpaid student loans. A lot of people are wrestling with this, and it's a huge pain point for Gen Z in particular, also a lot of younger millennials, where student loans are just holding them back. It's really preventing them from traditional milestones like getting married and having kids and buying homes. And So the income-based repayment stuff is important. It's been very confusing because there have been different plans introduced at different times, and the courts have put a hold on some of them. And so the whole effort here is to streamline things. But this gets back to that central theme of affordability or lack thereof, and really just the fact that if you're among the 1 in 8 Americans with student loan debt, that's a really big deal to your finances. A lot of these balances are 6 figures. It really is impacting people's lives and their ability to afford other things. And a lot of Gen Zers are starting to challenge the traditional notion of the American dream being marriage, 2.5 kids, the white picket fence in the suburbs. A lot of people either don't want that or can't afford that. And student loan affordability is part of the topic here.
Yeah. Okay. Great. Well, generally speaking, how do you see the state of consumer debt and consumer credit evolving in 2026 before we close off, Ted?
I'm of the mind that the economy is better than a lot of people feel or realize, but perception is important too. Consumer sentiment has been really low for years now, really ever since the pandemic, and it's taken a few additional legs down recently. People are really bummed out about just the continued high prices, even though economists and policymakers correctly point out that the inflation rate is lower. The average person wants prices to actually roll back. And we know it doesn't really work that way. Lower inflation just means slower growth, but it's building on a higher base. But that's really straining a lot of people. Interest rates continue to remain elevated compared to a lot of what we've experienced the last 15 years. Tariffs have added fuel to the affordability fire. People are worried about the economy. The job market's weakened a bit. And yet, a lot of people have climbed this wall of worry. Stocks have hit record highs. The economy had a strong Q3, in fact, the strongest GDP reading in a couple of years. I tend to believe that things are better than a lot of people feel, but it's a very bifurcated economy. That whole K-shaped economy idea where the rich get richer, the poor get poorer. Credit cards are a microcosm of that. Are you in the half who's using cards for rewards and convenience, or are you the half that's paying the 20% interest rate? That sort of thing is playing out across the economy, just in terms of jobs and wages. And it's like that saying about if your neighbor loses their job, it's a recession. If you lose yours, it's a depression. There's very much an all news is local element to a lot of this, whether you own a home or whether you're renting, whether you're invested in the markets or not. The haves and have-nots kind of theme is really accentuating some of these concerns about affordability and sentiment. So even if the data is pretty good, the mood is downbeat, and that is real to a lot of people.
Thank you very much for your updates today, Ted. Where can we follow you and your work?
I am at Ted Rossman on socials. You can also find us at Bankrate on social media or on the web at bankrate.com. A lot of good information about how to manage your finances and hopefully have a better 2026.
All right. Well, here's to a prosperous 2026 for all. And yes, don't forget to pay off your credit card debt. We'll follow Ted and Bankrate in the links down below. Thank you so much once again, Ted. Happy New Year, and we'll see you again soon.
My pleasure. Thanks for having me.
Thanks for watching. Don't forget to like, subscribe, follow Ted and Bankrate in the links down below. And don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. New users will get $10 on their first $100 deposit. Again, link down below or scan the QR code here.